means millionaires and future millionaires. I'm Beene, a 28-year retired lieutenant colonel and former F-16 pilot. In the last 20 years, I've bootstrapped and side hustled one single family property into a multi-million-dollar apartment portfolio that includes almost 700 units. Today, my goal is to share with you what I learned during that process to help you become a wiser investor and a better millionaire. This is a continuation of our video and education series that I hope adds value to you, because the next several months as we come out of the COVID-19 crisis, I believe will be a buying opportunity of the decade. And I want to explain and teach and educate you so that you understand well the risk of real estate investing, you understand the topics and subjects associated with multifamily real estate investing, so that when the opportunity presents, you'll be ready. Today's topic is very important, and it undermines, and it's the foundation for the two principles that I believe are key to building your net worth and reaching your financial objectives. Principle number one is this: invest your money efficiently in a cash producing asset. Number two is make the transition into and out of that investment in a tax advantaged event. Those two principles, if you get those right, can and will accelerate your net worth. So, how do you do that? What steps do you take, and how do you apply those? Well, you apply them based on data. You apply them based on fact. You apply them based on expert opinion. How do we do that? Is today's topic. Today's topic is what real estate metrics are important, what do they mean to me as an investor, and how do I apply them? So we're going to talk about that today. Why are these important? And I've already underlined that by saying that these are tools for you to use so that you can compare different real estate projects, and you can compare different real estate investments, and you can also compare different real estate teams. And you're comparing apples to apples, even though the projects may be dissimilar, or the teams may be, or markets may be different. That's going to allow you to make the best decisions, and it's going to allow you to understand the risk of project A versus project B. So that's why today's topic is important, and that's why understanding these metrics and ratios is critical. But not only do you need to understand them, but you have to understand, what does it mean? What does IRR mean to me? I see the number and I see the percentage sign, but is a higher number better than a lower number? In some cases, yes. In some cases, no. So we're going to talk about that. But before I do that, I want you to understand that the objective today is not to help you pass a financial test. It's not to help you become a PhD level economist or economic professor. My goal today, and we'll go over those calculations, but my goal is to really help you understand the principles behind these metrics so that you know how to apply them. So that when you read a pro forma or you read a financial model, you'll see that number or metric and you'll think, I understand what that means. So just realize I'm going to explain these in a very basic method and focus on how they apply. So, having said that, now you understand why it's important. Now you understand the framework of our discussion today. Let's talk about the ones that are used across the commercial real estate industry. All right? The very first one that you'll see more than likely is yield. All right? Yield is a projection. It's a future calculation of your return. Right? So how is yield calculated? Most of the time with real estate, it is cash flow over an annual period divided by your initial equity that you put in place there. As an example, if I have, very simply, if I have $1 per year invested over $10, I invested $10, that would be a 10% yield going forward. That's a projection. Oftentimes you'll hear that or see that in a portfolio as cash on cash return or a project yield, and that's what they're talking about. Cash flow over the value or oftentimes the initial down payment, if you will. It's important to understand that number because that's going to tell you the amount of money that's coming back into your pocket from this investment. Yield, cash on cash, return is often how that's associated, and you understand why that's important. The next topic, okay, is IRR, and that's a very common ratio and very common metric used in commercial real estate. IRR, internal rate of return. So to understand what this is, because this is a slightly more complicated ratio, but it's very important. So to explain what this is it takes the future value of money or cash flows and brings them all into the present amount. So in other words, would you rather have $1 today or $3 in 5 years from now? That would be an example of a calculation that could be done with net present value. And it depends on what your goal is, and it depends on what the project is. So the net present value of that $3 in 5 years from now could be discounted to today and say that value is worth a 9% discount, and that would give you an idea of comparison. So that is what the principle of IRR, internal rate of return, is. The net present value, today's value of tomorrow's money. Now, here's the complexity that IRR holds. It's not just $1 amount, but it's a string of dollar amounts over the whole period. Let me give you a practical example of that. A typical real estate business model may mean a 5-year hold period. So we're going to execute a 5-year real estate project. We're going to put $100,000 of investment. Year 1, we return no cash flow because we're reinvesting the cash back into the improvement of the project. Year 2, we get a $10,000 distribution from cash. Year 3, we get a $15,000 distribution of cash. Year 4, we get a $20,000 distribution of cash. And then year 5, we sell the project. So we have that total amount of money distributed over the whole period. What does that mean, and how does that compare to a project that instead of holding for 5 years, we hold for 2 years? How do those compare? And this is where you would use IRR, internal rate of return, to make that comparison. So what would happen on that first with the 5 year is I would use the IRR calculator, and it's a very complicated formula that I don't want to get into now, but you can find it online or you can find it in Excel to calculate those discounted cash flows at irregular amounts at irregular intervals. And it brings that all forward to a percentage or to a ratio. And that is really, in my mind, and this is what I want you to hear about IRR, is it is the rate of real estate investment growth. It's a time frame. It's a net present value. So it's associating the value of those cash flows into a time frame. So it's basically telling you, and this is what I think about it, again, in principle to understand this, it is how fast am I getting my money back? Okay? You can have the same number, 10% IRR, over a different period of time and of a different return on that investment, but the higher the number means the faster you're getting that number back into your pocket. Okay, IRR is probably the most complicated and the most sophisticated ratio in commercial real estate, but hopefully now you understand the principle behind it, behind the curtain of what it's trying to explain to you, because you'll see that ratio IRR in almost every commercial real estate investment opportunity. The third important metric is return. Return is similar to yield, but return looks back. It's a retrospect look. It's similar to return because it takes the combination of your cash flow or your distribution, but it adds to that capital gain. Yield, which looks forward, which was the first vocabulary metric, does not take into account capital gain. It just takes into account cash flow. Return takes cash flow and capital gain, and it's a retrospect look. That calculation is simply the total amount of return I have divided by the initial down payment or your capital that you brought to that project. So that's what your return is. The fourth and the last common metric that you'll see in commercial real estate is equity multiple. And this is very similar in concept. In fact, there's very little differences between this and total return. So you'll see the equity multiple, sometimes it's abbreviated EM, as the total amount of dollars returned each annual year-by-year distribution to include the amount of cash that you've benefited or capital gain you benefited from the sale. Add all those numbers together, divided by the amount of money that you've invested, and that is your equity multiple. You'll see that as a percentage of 1 or a numerical number. So if I have an equity multiple of 1, that means for every $1 I gave you, I got back $1. So if you saw an equity multiple of 0.95, that's bad. That means for every dollar that I gave to you, I got back 95 cents. Not good. Equity multiple of 2.5 means for every dollar I gave to you, I got back $2.50. All right. So that's equity multiple and the principle behind it. So when you put all of these metrics, there's advantages and disadvantages to look at each. But it's important when you're making that investment decision to compare all of these metrics together, because they give you a clear picture of your investment and they help you make a better decision. So the project comparison. Now, once you've got project A, you've got your yield, cash on cash return, you've got your equity multiple, and you've got your IRR. and you got your holding period. That's project A. Now you can compare the results of that to project B, the same statistics or the same ratios, and now you can make a better investment decision based on what your financial goals are and your business strategy. Okay, so those are the important metrics. Now let's take a look at current market conditions so that you can get a feel for, hey, that project that Lane just offered me with a 19% IRR and a 2.1 equity multiple on a 5-year project hold, is that a good investment or is that not a good investment? And how do I even know that? Well, one of the best sources of data is CrowdStreet. They validate institutional quality investments for their platform for investors to qualify. And then they list those things with very strict calculation requirements and assumptions, and they list IRR, yield, equity multiple, holding period. You can find that on the CrowdStreet platform underneath their market performance. And I've got a copy here that I'd like to go over to show you what a lot of these multifamily assets are competing for and what the standard would be. So based off of this printout that I have from CrowdStreet Marketplace, they've evaluated 31 different offerings on their website. I didn't look at all those, but this is the information. The IRR average over those 31 offerings, 26.3% IRR. The equity multiple, 1.56, and the average length of hold, 2.1 years. Now, that was actual results from 31 offerings. Let me caveat that by saying I do not know, and I'm not reflecting what market they're operating in or the time frame of these statistics. This may have been in 2015, 2016, when the market conditions were in hypersupply and all projects were executing well. Today, because of the impact of COVID and the recession the economy's in, you may look at a number and it may not match this, but that's not necessarily indicating that that particular project is bad. You just have to look at it in context of the market cycle and the market, the real estate market. Right now, off of their website, okay, they've got about 20 or more projects currently offered for investment. And they've got them broken out by projected financial metrics and then the actual metrics as well. Again, I'm not advocating for them, for or against them. I'm just showing this as an example of where you can compare Lane's project I'm offering you with the other projects that are potentially investments for you. But as far as the IRR goes, and I'm looking here at the printout, the average IRR is in the mid to high teens is what I see here as far as results and as far as the actual projections. It looks like the majority of these are not on their projection. In fact, they're falling short of their projections. But anywhere from the lowest is 14% IRR projected, and then the highest is 28% IRR. So in that time, in that period, right around 20 plus or minus a couple percent, if I heard that number, probably in the ballpark, okay, of an advantage or an advantageous investment. Going over to the right, the actual equity multiple, I see numbers here across 20 different samples of anywhere from 1.1 equity multiple all the way up to 3.6. So that's the equity multiple that is currently being listed on this. And then the hold period is anywhere from, again, just looking at these that are currently in their queue, 1.5 years all the way up to 10 years. So you can use that to help you determine if this investment is suitable for you. But you have to understand again that any one metric standalone is insufficient. You have to put those metrics together, understand what they mean in principle, understand how that applies to you so that you can make the right decision. Does this investment line up with my real estate strategy, and will it help me achieve my financial goals the safest way and the soonest way? All right, so that's a good discussion today to help you understand real estate commercial investing better. Because I honestly believe, and we're in the middle summertime frame of 2020, over the course of the next 9 to 12 months, there's going to be a tremendous buying opportunity for us to invest our capital in those two principles that I already mentioned are key to building net worth. And that is, number one, efficiently place your capital in a cash producing asset and make that transaction in a tax advantaged event if possible. I'm glad you watched today's video and education topics. If you have any specific questions about these, reach out to me. I'd love to talk to you more about it, explain in depth if necessary, or go into specific examples if that's required. If you want to connect with me, you can do that via our Facebook page, Pilot Legacy Private Equity Group, or you can connect with me via email or our website. I look forward to bringing more opportunities to you and helping you become a smarter investor and a better millionaire. Thank you.